There's a big myth that you have to keep every single one of your receipts to be able to take a write-off on your taxes, but that is not true, and let me explain why. That's because if you're using a debit card, a credit card, or your bank account to pay for any business expenses, then essentially that could act as your receipt to show proof if the IRS ever audits you. And there's a general rule that if you have an expense that's less than $75, you don't technically have to save the actual receipt. That bank statement should be sufficient proof. However, if you're getting into bigger, higher expenses and some unusual expenses, then you want to keep proof. For example, if you're having like a fancy dinner with a client and you spent like $1,000 for two people and you're writing that off as a business expense, then I would document what that meeting was for, keep the receipts, name who the guests were, because that can come up in an audit. But for general, ordinary, and necessary business expense, like things that you need in your business that are normal, then your bank statements and your credit card statements should be sufficient proof, and you don't need to keep every single receipt. However, when you're spending money with cash, that's the problem. That's when you have to keep the receipt, because when you spend with cash, there's no paper trail besides what you say. So if you have an invoice or receipt to back up that cash expenditure, then that would be even better.